Hello and welcome to Stringham Real Estate Edge. We know the Federal Reserve is the country's central bank, yet most of us don't understand the role of the Fed in the economy and the real estate market. Our guest today is John Mondragon, Senior Economist, Federal Reserve Bank of San Francisco, to answer some of our questions. John, it's great to have you with us.
Thanks very much for having me. I'm delighted to be here.
How has the pandemic impacted the real estate market today, John?
So it's been extremely varied and extremely interesting across a wide variety of markets. I think you really have to think about the different segments of the real estate market because the impact of the pandemic has really varied. So it's pretty clear that commercial real estate in major urban areas has been deeply affected with like large vacancies. As people are moving into remote work or have moved into remote work over the pandemic, you've seen huge changes in the commercial real estate valuations and the rents that they're able and willing to charge. I think the big question there is going forward, how as the economy responds to the vaccination campaigns and people are coming back into the offices, are they going to be coming back into all of the offices they used to occupy? We're still waiting to see that. I think in the residential real estate market, there have also been huge effects that were very, very different. So it is true that in some of these really big urban centers like New York, San Francisco, you've seen people moving out and rents and prices not being as elevated in other places. But broadly, there's been huge activity in the purchase market, large increases in house prices pretty much across the board in the country. And so actually what it looks like is there's been a huge demand increase in residential real estate for most markets that we're looking at.
Sure. Well, speaking of the residential housing market, this market has outperformed astonishingly the grim forecast from earlier this year. How did that come about?
Yeah, it was. I was one of those people thinking that we were going to see some pretty, not exactly 2008, 2009, but some pretty bad outcomes. I think it's been a number of things, and they're all super interesting. It's hard to tell which has been most important, but we can go through them because I think they're all very important. One thing we talked about a little bit in that there's been this shift from people who have wanted to rent and live in city centers to either moving very far away to less dense areas or moving to nearby metro areas and wanting to live in larger single family houses. So there's been a relative demand shift that seems to have shown up in increased prices in these housing markets. The other big thing is that there's been a huge and very rapid decline in interest rates. As we entered into the pandemic in March of 2020, there was a really large decline in interest rates from the Federal Reserve Bank, and that's propagated through the economy and lowered mortgage rates that a lot of people are facing. That's also led to a large increase in their willingness and ability to pay for houses. Other things that have been important, I think, is that a lot of people, we really worried that as you saw unemployment skyrocket during the pandemic, that was going to lead to a lot of foreclosures or at least forced sales as people were unable to make their mortgage payments. And I think a number of the policy responses have been really important for reducing that likelihood that, unemployment insurance has been extended and been generous enough that people are able to cover their payments. And that's prevented a lot of forced sales. We'll see what happens as those policies scale back. But the stimulus, the various rounds of stimulus have almost certainly helped reduce kind of people who have to sell or who end up in foreclosure because of their inability to make their payments. And so I think all of these things have been important for explaining why housing markets have been much more resilient than we were expecting, why we didn't see a large decline in house prices.
The housing inventory in the Fed's 12th district is down 40 to 60% year over year. What's driving that change?
Yeah, it's very related to what we were just talking about. So, and that's something I've been looking and following about very closely because it's tied into why we haven't seen these house price declines. So, if you think about what's driving the current level of inventory right now, right, it's going to be the flow of listings that are coming on, the people who are putting the homes up for sale, and the flow of people who are looking for houses to buy. What we've seen is a large increase in the number of people who seem to be looking to buy houses. Some of this is coming from, like we said, people who are looking to change where they were living. They had been renters in expensive urban areas, and now they're looking to purchase a home, maybe for the first time.
Mhm.
Other people are scaling up their home purchase, right, and just trading the houses. And so you've seen this large increase in demand coming. Low interest rates have definitely played a part in that, as it's made the payments that people have had to pay smaller. Um, and you have not seen an expansion in the supply of houses, right? So if you look at the flows of inventory that are coming online each month, over 2020, it's actually looked over the whole year uh, more or less like an average year. Obviously the inflows of inventory were really low in early 2020 when the pandemic was first raging and everyone was kind of holed up. But as things started to normalize a little bit, inventory was higher than it was normally. And so over the whole year, it's been pretty average. And so we're seeing a pretty average flow of new inventory, but those houses are getting snapped up very, very quickly, right? The amount of time that houses are listing in a lot of markets has fallen dramatically. And
The
so actually part of, and just to build on that, oh, go ahead,
Sure.
sorry.
No, please finish.
Oh, I was going to say, and then so what we see, right, if the demand has gone up a huge amount and the supply has not really shifted, then that's going to go into prices, that we've seen
Mhm.
pretty healthy price increases across the market as people are bidding up the available supply that we've seen.
I
And so
see.
it's interesting to think about, what will there be any changes in the supply that we see going forward? That's hard to say anything on the scale that's gonna equalize what the large demand shock that
Mhm.
we've seen. So it's really a question of like how persistent is that demand going to be, I think.
Sure. We know that the Fed studies institutions that supply mortgage credit to both households and businesses. What do your findings tell you about the current state of the lending market?
Yeah, there have been some really big changes, I think, along the lines that you might expect, given the size of the economic shock that we've all gone through. The unemployment rates were skyrocketing at unprecedented levels in the early pandemic months. And so what we, as best we can tell, and what we've seen consistently from, say, February, March of 2020, even until now, is that credit standards seem to be really tight across the board, particularly in residential, but also in commercial credit lines. So what that means is that if you look at the home purchase market or you look at the refinance market, the kinds of borrowers that are getting credit tend to be the highest kind of quality borrowers in terms of default risk, right? The borrowers who have pristine credit history, who have lots of cash available for down payments, who don't have any sort of spots in their recent credit record.
Mhm.
This makes sense. I think there was a lot of economic distress in the economy, and lenders looked at their risk and were very unwilling to take it on, or at least much less. The standards seem to be the tightest that they've been maybe since 2013, 2014.
Mhm. Sure.
And these risks, part of it is there were these forbearance policies that were implemented to try and, make sure that borrowers who couldn't pay because of the pandemic didn't lose their home. But even without that, the unemployment increases were the primary risk.
Speaking of forbearance, will borrowers exiting the mortgage forbearance programs will that lead to a spike in foreclosures in the near future?
It's a really important question, and we're all waiting, I think, to see exactly how it's going to play out. Um, the question I would think about is, well, I would think that foreclosures are relatively lower risk, but primarily because the house prices have remained so elevated, right? Typically,
Mhm.
you're only going to see a foreclosure if the borrower doesn't have the equity in order to just be able to sell the home and kind of
Sure.
move into a cheaper home or a rental. And so that's one of the really big differences between this recession and what we saw in 2008, 2009. 2008, house prices had collapsed. And so lots of borrowers couldn't walk away. And so they had to enter into the foreclosure process. I think what we're seeing now, because house prices have increased strongly, right, have not fallen, is that borrowers who are not able to make their payment are typically going to have the option of selling their house and walking away as opposed to entering into foreclosure. Now, the question is, if a lot of these borrowers have to do that at the same time, are you going to see enough inventory come online that house prices might end up, slowing or maybe even falling? But that, I think, it's a big question. That would take a lot of inventory to see that happen. But it's an important thing, and we're not exactly sure how it's going to play out, given, how many borrowers, when they exit forbearance, are going into, have already landed back at their job.
Mm-hmm. What's the current level of mortgage debt outstanding in the country, just approximately?
So yes, it is large. So the most numbers are going to give you around $10.4 trillion in outstanding mortgage debt. The U.S. housing market is one of the largest housing markets in the world.
That's a big number. Now, how does that compare to 10 years ago, John?
So actually, it's interesting. It's not that different if you just look at the nominal number. That is, if you don't take into account any change in inflation over the 10 years and now. In terms, if you actually think about the fact that we've had, pretty moderate but sustained 2% inflation over this last 10 years, it's actually a much lower number in real terms. And so there's a lot of interesting things that might suggest about what the position of the economy now relative to 10 years ago. Yeah, I think there's a number of things going on that are super interesting. So typically, I think we would expect, and what we've seen if you look over longer run of the US, the debt increases pretty naturally in the household market as the economy grows. Now, in mid-early 2000s, I think we saw, and most economists would say this, pretty unhealthy expansion in credit supply. A lot of people getting very strange types of loans, and loans that they weren't going to be able to pay back realistically. And so there's probably a much higher increase in debt and a debt load than we would normally like to see. And we saw the implications of that in the financial crisis. So coming out of that and looking now and saying 10 years later, we've seen not the kind of increase in debt that we might expect, as the economy has grown substantially since then from that recovery. That one could argue, and a lot of people have, that there's been a real tightening in credit standards that has not loosened very much since the financial crisis. And that actually, if you look historically, that maybe our current credit standards, say pre-pandemic, were tight relative to even, say, pretty normal times of the late 1990s or very early 2000s. So I think what this could suggest is that we had a really bad scare with the financial crisis in the mortgage market, and that a lot of the market is still pretty shy with respect to lending to borrowers at different parts of the credit spectrum. The borrowers with maybe spottier credit histories are still having a hard time getting access to credit. And so this has had a lot of interesting implications. I think that if you think about subprime borrowers in particular, a lot of them entered the market at kind of the worst time. They bought at the highest prices in 2006, 2007, and exited through foreclosure or for sale at the worst time, 2009, 2010, when prices were at the trough. And then as house prices have recovered, haven't really been able to participate in that recovery in house prices. And so I think there's interesting discussions to have about credit access and what it looks like now as we recover from another recession that we know has really affected borrowers at the lower end of the income distribution, and where those credit standards should be to look like a healthy kind of economic recovery.
Sure. Given the level of mortgage debt outstanding, what's the resiliency of the banking industry to a sudden real estate price decrease?
Yeah, super important question, one that the Federal Reserve is very interested in. And so it's, hard to say exactly how any industry would respond to large price increases. But what I can say with a lot of confidence is that there were a lot of lessons learned from the financial crisis, when the collapse in house prices really stunned everyone and caused a huge amount of distress in the mortgage market and in the banking industry broadly. So a lot of the changes that have been made have been for the better. So I think what we've seen, even though there have been a lot of defaults and forbearance, the use of forbearance in the mortgage market, we haven't seen that extend into instability in financial institutions. And I think that reflects that there's been a lot of healthy regulation of financial institutions leading up to this recession, and that some of the things that we put in place, like Dodd-Frank, have done what they were supposed to, of make the banking industry resilient to a large shock, so that it doesn't propagate further and make things even worse.
Sure.
Fannie and Freddie have been under pretty tight oversight, and so they are continuing their function so that the mortgage market, doesn't collapse. And I think that basically what I would say is that we are in much better shape now to a large decline in house prices than we were entering into 2008, 2009.
Well, compared to 2008 or that period, are consumers and small businesses, for that matter, better positioned to withstand a sudden price adjustment in the real estate market?
Yeah, so I mean, relative to what we were just saying, that we haven't seen the debt increases that we normally would have expected with the kind of growth that we've seen. The answer, I think, would be yes, that borrowers who've been in the market now, in the mortgage market and in the commercial market, have come into the market with more cash on hand. That is, their loan to value ratios, their down payments have been healthier than they were in 2005, 2006. And so their payment levels have been lower. They haven't been as likely to be in non-traditional mortgage products where, the mortgage payment is going to be adjusting sharply, unexpectedly, and causing some sort of payment shock for borrowers. And so I think that's been a big reason why we haven't seen as much distress as we have. But then the other thing going back is the policy response to this COVID recession has been much stronger from the beginning than it was during the financial crisis. And this isn't to say that policymakers were better or worse at in either of these situations. It's mostly, I think, that we've learned a lot of lessons from the financial crisis, and we've used those lessons to kind of make sure that this recession isn't as deep or as long as what we went through in 2008, 2009. Sure. And so those borrowers, even if they're not better positioned, are going to have access to policies that borrowers in 2008 and 2009 didn't. Say, really generous forbearance policies, longer unemployment insurance, that sort of thing.
Mm-hmm. Let's kind of change gears for a second. Talk about the commercial markets. Are banks carrying a heavy concentration of CRE loans today? A heavier than normal concentration?
Yeah. I wouldn't say heavier than normal. So I think if you look at the banking system overall, there's maybe, here's going to be another big number, but maybe 21 trillion in total assets on bank balance sheets, if you're looking in 2021, 2020, which is, a lot of money. If you look in their exposure in particular, to CRE, it's going to be about 2 trillion. Which is, again, a very large number, maybe 10% of the overall portfolio.
Does that concern the Fed? Is that?
So, the Fed is and I should be very clear, speaking purely as an economist here. I think the Fed, as a regulator of banks, it takes very seriously their exposures, across any sort of market segment, right? So their holdings in the commercial real estate market are subject to regulatory oversight to make sure that the standards that they're using and the size on their balance sheet is not can withstand stressful scenarios. So the very, very largest banks are subjected to what we call stress tests to analyze, okay, in the event that there's a large decline in house prices, how might these assets perform, and is the bank going to continue to be able to do its function in that situation? And so the fact that we haven't seen widespread distress in banking institutions, I think, is just a testament to how effective the regulation has been leading up to this crisis. Yeah.
Well, drilling down just a little further on the commercial side, what's the current economic status of the commercial office market? I know they've been under a lot of stress with people moving to home offices to work. How do you see that playing out?
Yeah, so that's a huge question, and I think it's the outlook. There's a lot of different forecasts, and I think the big question is going to be, how, are we seeing something more like a permanent shift to remote work? Are a lot of, to take San Francisco as an example, very expensive commercial space. Companies had to pay a real premium if they wanted to be in the center of Silicon Valley. Are they going to be willing and interested in paying that premium going forward? Now that we've all seen that the remote work can work pretty well for a lot of people, and so the outlook is going to really depend on how much of a return to cities and to the centers that you're going to see from these sorts of companies. And for that, I think it's going to take a long time to see how this transition works out, especially as the pandemic has lessened in its severity. But if we did happen to see some sort of resurgence, that would delay any ability to sort out, is this a permanent shift or is this just a temporary response to the pandemic?
Sure. So
But
I
it'll be
guess that
really interesting and important to see what the.
so I
Sorry,
guess
go ahead.
that chapter is yet to be written.
Yes, still being written as we're talking here and even doing this remote interview.
Sure. John, how do changes in monetary policy impact prices in general and real estate prices in particular?
Yeah, this is something that economists are still studying and have studied to this day, because the channels and the relative strength of different channels are changing all the time, and it's really important to understand. But I think the big picture idea of how this works is fairly simple. So the Federal Reserve is controlling specific interest rates that are paid by, you can think of as being paid by or received by the largest financial institutions or the largest kind of most liquid financial markets. And so when the Fed lowers rates in those markets, it's lowering the cost of funding for these institutions. And that is thought to be then propagate throughout the economy so that borrowers and small businesses and all the other participants in the economy are also seeing those lower rates when they turn to borrow and think about their activity. So then the question is, okay, if I'm now looking at a lower interest rate when I think about taking out a mortgage or on my credit card or for an auto loan, what are you going to do? You're more likely to then spend. Right, you're more likely to take out that loan or to go, make purchases with that credit card. And so then the idea is, right, that as you are spending more, that's going to put some pressure on prices, right? As we're all spending more for the same number of goods, one margin of adjustment is more production of those goods, but another margin of adjustment is that the prices of those goods might go up a little bit. Right. And so that's kind of how you would traditionally expect to see that reduced interest rates are going to propagate into the price level and some inflation. And then real estate prices are very similar, right? You can see the link even more directly, right? That is, the interest rate goes down and the size of your mortgage payment goes down. You're going to be able to afford a larger house, a more expensive house, and so that's going to again put up a little bit more pressure on those prices.
Well, obviously, there appears to be a strong relationship between interest rates and real estate prices. One of the real estate pricing indices is the 10-year Treasury. Is there a direct relationship between this rate and the interest rate set by the Fed?
Yes. So the 10-year Treasury rate is determined by the market, but as the Fed does not control that, but it does reflect expectations about future interest rates. So the Fed, the rate that the Fed does control, the short-term rate, when people expect that to go up, you see that priced into the longer 10-year Treasury rate.
Sure. Well, given the current state of the economy, which in some cases is really hot, is the Fed concerned about near-term inflation?
So, speaking only for myself, not able to speak for the Fed
Okay,
more
sure.
broadly, but I think what we've seen, or what we expect to see, is that there will be likely a bump in prices as the economy opens up and as people go out and buy things that they haven't been able to or willing to buy during the pandemic year. But I think it's unlikely that these price increases are going to be sustained. That is, we've really seen for a long time now a pretty stable 2% or even below 2% inflation rate for the Fed or across the economy. As we recover from the pandemic and get more closer to normal, probably the best expectation is that we get close to that. And that's what the Fed policy is designed to do.
So at least currently, the Fed would like to maintain at or near 2% inflation, at least for the foreseeable future.
That's right. That's the target.
Okay.
And so the Fed is committed to always kind of keeping inflation near that 2% rate. I think
Sure.
in the very short term, we probably will see some bumps around that, but I expect it to be exactly around that 2%.
Sure. John, I've read that the Fed plans on keeping interest rates low at or near current levels, at least for the foreseeable future. Is this true? And if so, what's the purpose of that strategy?
Yeah, so the idea with that is, and it's a lesson that we've learned from the financial crisis, is called forward guidance. And the basic idea is that you commit and you let people know what your policy is going to be going forward. And that should show up in kind of lower rates throughout the economy and hopefully getting some more of that stimulus. And so going back to, as you mentioned, that 10-year Treasury, when the Fed comes out and says, that as the economy is recovering, we're going to try and help that recovery by keeping rates low until we really think we've come out of this. That's going to keep the 10-year Treasury rate a little bit lower, which you're going to see propagated through lower mortgage rates, lower long-term bond rates more broadly. And so that's the basic idea, is that if you give people guidance about where interest rates are going, it's going to provide a bit more stability and comfort that rates are going to be low for a while until we've really recovered. And then that should be even more stimulative and help us get out of this recession even more quickly.
Mm-hmm. Well, we have time for just a couple of more questions, John. If interest rates were to increase, let's just say 1%, what impact would that have on real estate prices?
Yeah, so a 1 percentage point increase in interest rates would be a really large and rapid increase in interest rates. And so the expectation of what would happen there is it would have a pretty sharp contractionary effect on real estate prices. I think you got to think about what that would do to the payments that households would expect to make on mortgages and how many people would be willing or able to make those payments at an increase of that size. And then similarly in the commercial market, when you think about firms financing some of these investments and whether or not they're going to be willing to do that at that size of an increase, probably a lot of them would not be. And so that would be my expectation of what would happen with an increase in the rates like that.
Sure. Well, given the uncertainties in today's economy, do you think that we may see some type of financial crisis in the near term?
So I guess the thing that comes to mind thinking about this question is how surprisingly, to me at least, how resilient we have been throughout this really large COVID shock. So this was an extraordinarily fast increase in unemployment and a really huge shock to so many businesses, right, in so many different sectors. And, it was really, watching these numbers come in was really staggering and just,
yes.
You have flashbacks to the kind of collapse that you saw in the financial crisis. And then, sitting a year out, there have been a lot of really important policy efforts that have gone into this and a lot of, hardworking people making, the right decisions for themselves at different stages. But we've weathered this in a way that I'm really surprised that we've seen as little disruption. If you just think about the real estate market as we could have, when you saw the size of the shock in March, I personally was expecting, something more like devastation in a lot of these markets. And I think what we've seen is not that. And there's still a lot of work to be done. There's still a lot of people who don't have jobs, who had jobs before and who want those jobs. And so the recovery is definitely still underway. But right now, I think the cause for optimism as these vaccines are rolling out and such is pretty high, I think, for mine, yeah.
Well, John, that concludes today's program. We thank you very much for your time. We appreciate your insight on the interest rates and the Fed, and we greatly appreciate you being with us. That concludes this episode of Stringham Real Estate Edge. Today's program was brought to you by Stringham Schools, educating real estate professionals since 1989. Visit stringhamschools.com to learn more. We want to thank today's guests, and don't forget to tell us what you think in the comments section below. I'm Gary Barnes, and I'll see you on the next episode of Stringham Real Estate Edge.